Organic growth to me is just geology. It's time and pressure. This is what we're trying to achieve, and this is how we're going to go about doing it. And in 12 to 18 months, you will see the green shoots of that.
Hello again, everyone. It's Al Sica from Sica Fletcher. We have my buddy Kevin Angelis, co-founder and managing partner of BHMS Investments in the New York metro area. He's one of the most successful private equity-backed investors in the space. Kevin, it's great to see you today, buddy.
Al, how are you?
So, Kevin, the main thing that I want to really dig in with today with you is first is how we got together, successes we had together, in the marketplace a little bit, and your thoughts as a PE perspective. The PE space has been the darling of insurance brokerage, and you were right on the forefront of it. We were going through things, and you looked at me and said, "Hey, Al, don't tell me what I want to hear, okay?" And I said to myself, oh boy, I met my match here. And I really was impressed with you right from the get-go. We did a few deals for Bob, and when it was time for you to try to create some type of exit or recapitalization, you were nice enough to give us the chance to help you. When we did a monster deal with Abry for the recapitalization of the Hill Group. I've earned tremendous respect for you and what you've done. You're still very young, and all the accomplishments you've made. And that was the beginning of it. And then on to PCF with Peter Foy. We backed Peter. And look at Peter now, although he's the chairman of PCF, that business is north of 900 million when we started with 5 million. It's amazing. You're easily one of the top leaders, and that's why you're on this cast, Leaders and Legends, okay? Leaders in the insurance distribution space from a PE perspective. So I'm really honored to have you here today, both as a partner, a friend. We've invested alongside of these things and done very, very well for each other.
Well, thanks, Al. Appreciate that. That's very, very kind of you and generous. And yeah, it's been the better part of actually greater than a decade that you and I have been kind of going to battle at this. And like you said, winning way more often than not. So it's definitely been fun. I do remember the early days, and I remember that meeting very vividly. I remember you and I maybe always had a good rapport, but maybe a little bit of a checkered beginning until we found our footing. And you cut that deal short with Hill, because what actually we did when we sold to Abry is you brought two sizable Rhode Island agencies to the table. Right. And so it actually was a contemporaneous acquisition of two large Rhode Island agencies, one more P&C, one more EB, that then bolted on to basically become a sizable, if not the Northeast presence of Hill, while we were actually selling the broader platform at the same time. So it was sort of three reasonably sized transactions in one that all sort of hit on the same day. So that was if anybody has ever been in the weeds on a sizable insurance brokerage add-on, I think they can appreciate doing two sizable add-ons and a platform deal all closing on the same day was all that you and I could handle for a little while.
Well, I think that's what I always tell people is we ended up, it was a lot to do, right? Many attorneys involved, because really what we did is that was Cornerstone, was the EB firm, Rob Khaleesi, okay, and his partner, and bottom line is the other guys were GenCorp, who weren't even really a client of ours until they wanted to merge with Cornerstone. So Cornerstone was my client, and here comes GenCorp. They wanted to merge because they were about the same size, about 8 million of revenue each, and they wanted to merge. And basically I said, hey, we'll merge on paper, but then what are we going to do with it? And then they hired us, okay? And we had both of them, and we went to the market. I went back to you guys and said, look, you can pull this off. And at the same time, we brought Abry in. So I always tell them it was a push of a button. We did 3 transactions in one push of a button on June 24th, 2015 was the date, okay? And I'll never forget that. And that was really what springboarded Hill at that time and brought Abry in. You had done a great job with Bob to get him to that point. And it was just magical. Yes, one of the better transactions we've done. It's absolutely true. Exactly what you said is exactly what we did.
Yeah, and for us, I mean, maybe if you want me to give a little bit of our story, that
Please.
as you alluded to, we've done four retailers. So um, retailers sort of are part of our story all along the way. I think that you had mentioned we partnered with Bob pretty early, which is true. And one of the reasons we did that is there was some nice symmetry between what Bob was trying to accomplish and frankly what Rob and I were trying to accomplish as a firm. So the Hill Group is our second deal. So we had previously done one transaction not in financial services, and stumbled upon Bob a little bit actually through an RIA connection in the greater Richmond area. And I had been, when I was at Morgan Stanley's private equity group, I had been part of the hub transaction with APAC. So knew enough to be dangerous, and certainly knew of the Hill name. So when we met Bob, as you said, they had done one deal with effectively Bob's family's capital, and gotten them to a little bit of revenue and effectively break even on the corporate team, some of which were there, some of which weren't. So we saw a lot of obviously great industry. And you had mentioned you want to talk about that maybe a little bit later in this discussion, but great industry, great brand, and Bob was hungry too. And so it was just nice. Bob and I used to always talk about how sort of the Hill Group and Bob's career has progressed in a similar way that ours has. So as a firm, so yeah, we did that deal. We did right around 20 transactions with that. Took it from very little of revenue to ballpark 50 million of commission revenue in a pretty short period of time. Obviously, as you mentioned, with a lot of your help, and then executed that transaction. I think it was about 4 year hold, somewhere in that ballpark.
Yeah.
And then to your point, we turned around pretty quickly. Frankly, through you and with you to Peter. That was obviously Hill was an East Coast strategy. Look, that was early days. That was pre Assured Partners, pre Acrisure, pre sort of the household names that I
It
think
was.
you and I
Yes.
can all rattle off. The manner in which you go about the business, at least I think smart people in the space, has changed entirely. I think the way to be successful in the space has changed entirely. Not to say it was easy then, but certainly different. And that was sort of our first real foray as a firm here at BHMS into the space. But then, as you alluded to, pretty quickly turned around with Peter. I would say we had that deal done within 6 months. I would guess 6 to 9 months of exiting the Hill Group. And Peter, we saw everything that you said. He really hadn't done a lot on the M&A side in insurance brokerage, but Peter was an accomplished business person. He had made a number of investments sort of outside of his agency and general business. I mean, he knew his way around sort of a boardroom,
Right.
but and had built his agency, as you referenced, about 5 million of commission revenue organically, mostly an EB shop, but bigger business EB. Which bigger business EB for that size, I don't want to say it's rare, but you don't see it as often as maybe some of the other types of agencies. Al, you and I talk about this all the time. The person, and it is a person to start with, is the GI Joe. It's half the battle. Can Pete sell the dream? Can Pete make it happen? Because at the end of the day, all the training from us and from you and the resources and support we can provide and you can provide don't mean a rip if you can't get in that room and convince that seller. And Peter can, and obviously we've seen that now, as you referenced, over 900 million of commission revenue in, I don't know, 8, 9 years, something like that. But when you say we taught him the business, I'd say all credit to Peter. He's the one kind of making it happen. But yeah, like in the first, I don't know what it is, 10, 10, 12 management meetings that he had with sellers, like I was there. You can't go into a meeting in that instance and the seller says, well, how does an earn work? Or how does this work? Or how that, the answer can't be, oh, right. The
Yeah.
answer, you
We're
got to
just
have
gonna
an answer.
grow. We're just
You,
gonna grow.
yeah, exactly. Like you got to know. And Peter, again, unbelievably capable, but just needed a few at bats, right? And so it was a shame for maybe my wear and tear. I guess good for my mileage account, but bad for my body wear and tear that it happened to be in California because I was going West Coast a lot for those
Right.
early days and those early meetings. But we got off the ground pretty quickly there and ended up in little less than 3 years getting to about 27 million of EBITDA. I remember, we even sort of slowed the pace in the first 6 months because we had learned some good lessons from the Hill Group and wanted to build the business a little bit more strategically. I think you are now. That's actually one of my biggest things that I'm most happy about, and I have a very, very, very small part in this. You now are a golfer. So we've converted you over the many years, which you were not when we first started doing business together. We're always like, look, good shots lead to good rounds lead to tournaments, and tournament wins. And so we wanted to have that mentality a little bit more acutely with PCF. So we actually didn't do a deal for 6 months
Right.
to kind of get all of our ducks in a row.
Right.
And look, we learned from our previous experience. We learned from some of the competitors that came in, and particularly Acrisure and Greg Williams, and their speed to close, their speed to respond on the M&A side certainly influenced some of the things that we were trying to do on that front. In a relatively short period of time, took that to about 27 of EBITDA. When we exit, particularly the brokers, but I'd say a lot of our larger platform investments, we tend not to shoot the market and send it to X number of people. We tend to handpick who we think would be good partners, particularly obviously if we're going to lean on your expertise quite a bit. And so I think we went to two folks.
Right. Right.
With Hill, we went to one. We
Right.
went to Lottery, and we said, look, like, here's the deal that gets it done. They hit the bid, and it was certainly not easy, but that seamless. And the same thing with PCF. We went to two folks. We did roll in the HEGC transaction a little bit. I'd say a funny sort of, not funny, but kind of a bit of a crazy story there. When we were going to exit that, as you mentioned, it was March of 2020, which I think folks will probably remember. That was really when we were starting to get knee deep into COVID, and so it was West Coast Council for HEGC, and we were literally right at the finish line, and we were expecting the final turn of the purchase agreement. It was assigned with a subsequent close, and but everything released at that time, obviously financing commitment letters and everything released, and made it a binding contractually obligated transaction at that point. So we were waiting for the final turn, and I think it was like 11 o'clock East Coast time. And I remember I'm like, all right, well, they're waiting for me to sign this thing. So I just, laid down on the couch, fell asleep. I woke up at 2 a.m. It was in my inbox, and I went and I, docu-signed it, and kind of there we go. Woke up in the next morning, and kind of I'll leave the lender's name out of it, but got a frantic call from our lender and saying, hey, did you guys get your deal done yesterday? And we're like, yeah, we signed it last night. Why? And they were like, well, as of this morning, we're contractually obligated to fund, we're no longer looking at new investments. So literally, if we hadn't signed that purchase agreement at 2 a.m,
Yeah.
the next morning at 8 a.m, that lender shut off sort of all deals in the pipeline that they were not contractually obligated to fund. Just kind of twists and turns along the way. I remember you and I at the 11th hour, look, there was some, as there always are, some deal gymnastics, and
Yeah.
you and I were trying to decide, should we, shouldn't we, what's the good, bad, and ugly here. And so that was a crazy sort of ending to that story. And of course, it kept going. We stayed on the board, we rolled some equity, and that the PCF story has continued on. And then from there, pretty quickly, we turned around into, as you referenced, into Inzone. Funny enough, Inzone was for that lender I was referencing on PCF. The Inzone transaction in June of 2020 was their first deal that the lender did coming out of COVID. So we
Wow.
were their last one going in and their first one coming out, which is kind of ironic given our little crappy firm over here. We were the last one in, the first one out. But
Right.
Inzone's a little different model. Inzone is sort of small micro commercial, a little bit of personal. The end business split is similar to what you might see, sort of 60-20-20, or thereabouts, with PNC personal and EB, commercial, personal, and EB.
Right.
But their average premium per policy is much lower. I think they are, if you will, white glove service for the small commercial clientele. It's not a call center model. But it is the most, in my opinion, and what I've seen, the most heavily integrated strategy that's out there. And we've gone from just shy of 7 of EBITDA, a little bit shy of 5 years in, we're about 80, and we've done around 200 acquisitions. Our average size acquisition is about a million or a little less of commission revenue. So what we're really good at Inzone is sort of feeding on the bottom portion of the triangle. We particularly like where Inzone feeds. There's the pick your number, 30, 31,000 million of commission revenue or less. And that's what Inzone is really, really good at doing. And because of the highly integrated model, they're very efficient at doing it. So we buy very, very well. We grow organically very, very well through a unique sort of sell-in model that we have. And the business just kind of keeps chugging along. So, like I said, we've gone from just shy of 7 to about 80 of EBITDA. We brought in a partner November 23 in Lightyear. We're 50-50. It's been a great partnership thus far. And we have King too. So King is a little bit more a la PCF in that we found Chad King. I know you spent a lot of time with Chad. That's a Florida based business. Inzone is sort of more West Coast, Midwest, for the time being anyway. They've been slowly moving east. But Chad was a buck and a half of EBITDA. It was even small for us at the time, but the person is half the battle. Chad, if anybody's ever met Chad, has a really nice way about him. Grew up in the business, but certainly had other experiences outside of the family business that sort of rounds out his skill set. And we just like Chad and thought that we could do something special with Chad. So pretty modest starting point at $1.5 million EBITDA, and we're over 30 now. Again, just around that 3-year mark in. We also brought in Lightyear to partner with them, known quantity, that we think can help take the business to kind of 100, 125 EBITDA, which we also think can happen in a pretty short period of time. A little different model. I'd say it's kind of a hybrid between a PCF and an Inzone. Certainly some of the elements of Inzone exist, but maybe a little bit more bigger acquisition, bigger clientele
Right.
there. But certainly that's been going well. So we've been in the business since Hill been 2011, and pretty much almost the entirety with few breaks in between to today, and then now have, like you said, sort of two top 40-ish platforms, which we were 50-50 owners in.
Yeah, no, and Kevin, just a couple comments. It's very interesting, the story, and you kind of validated everything I said, but just along the lines of PCF and now Trucordia, we backed Peter because he was super well connected. If you remember, he was heavily in politics out there. Peter was always an accomplished businessman. When I say he didn't really know how to do the M&A, that was accurate, but he knew how to do everything else. And we saw a very hungry guy at 60 years old. I originally told him, I said, Peter, you nuts? Because he was our client. I said, you're going to compete against all these guys? You're going to run around the country? Yes, that's exactly what I want to do. And he's done amazingly well.
Yes.
On the recapitalizations, we've done about 8 of them. Okay. I appreciate what you're saying because I'm called by many unconventional. I wonder if I'm really the only one that is conventional, because I don't see why all these firms go out and talk to 30, 40 people and they dilute themselves in the market. We've been focused on the recaps we've done by finding that real hungry one that, if you know what's going on in the market, you know who the next 1 or 2 should be on the type of business you have. So to your point, Hill, Abry was a one-off, right? To your point, PCF, HCGC, and Abry, 2 people, right? We created a slight competition there that gave us a little background, okay? High Street, okay, which you're familiar with Abry, one-off. You shut out the marketplace a little bit when you do it that way, because once it gets publicized, we all know the lenders like to talk, okay? They get the calls from everybody, you and everyone else. If you're competing against, 20 other people, to me, it dilutes the value of people. Listen, everyone will take the meeting because that's their job, right? They have Monday morning or Friday morning meetings where they have inventory, and those analysts, those junior guys are supposed to bring it in. So they're hungriest when you start the process till they get under the covers, right? And you guys get under the covers and listen, you dissect it as good as everyone. And I've learned tremendously what the private equities want and what's important in the most recent things we've done in order to prepare our clients that we do get the assignments. And most of the assignments we get are the ones that we brought the money in originally and invest, and then we basically go out and try to find the next investment so we can get the capital infusion in and the liquidity out. I just feel like the way we've done it, you wouldn't argue, not only found the right partner for these things and it's worked, but the right value, okay, which is huge, right? Because, especially what's going on in the market right now, especially at the higher level with the bigger firms that have been around for a long time and are multi-billions over $1 billion, and they're now being looked at like publics. The market's resetting a little bit. A lot of that has to do with the interest rates and whatnot, but we'll get into that a little bit. So I'm glad you said that, because
from my perspective, 100% Inzone was handful of people, literally. King was a one-off, as you say. For us too, partner really matters. Obviously, for rolling, it is a simply complex business, meaning it's not that hard to understand. You can write what the business is in crayon, right?
Right.
Retain a lot, write new business. Hopefully you can do retain at 90, do 16% new, whatever you want to, whatever number you're shooting for. Yeah, 106. You can look at it on premium commission, PIF, fine, do M&A, integrate well, build a good machine. There's obviously a lot underneath that around sort of data, technology, things you're going to put in your producer's hands, efficiency, all that fun stuff. But at the root, it's a pretty simple business. But it's one that I was always fearful that the wrong partner, frankly, would screw up. If you, particularly when you start thinking about the M&A side of the business, if you've lived X number of retail broker add-ons, I mean, gosh, how many? I mean, you've literally sold hundreds, if not thousands at this point. I mean, you and I could probably have 7 pieces of information and decide sort of within reason, with the 90% accuracy, whether we would want to acquire that business or not, and with the confidence to actually follow through on that transaction. Yeah. And yes, there's a lot of diligence that has to happen beyond that, but it's simply complex in that if you start to overthink or question or over engineer from the private equity perspective, some of that on the front end, you're going to paralyze yourself in a sea of, as you said, 50 acquirers, and you won't get anything done. And so to me, making sure people stay out of the way of a good thing is as much a trait, and bringing a lot of other skill sets that investment firms tend to bring, is something we've always been really, really focused on, finding the right partner that's been in the space, lived it, understands it.
100%.
Because I think that does really matter, particularly in this space.
100%. And people by people, Kevin. Yeah. That's the end of the day. Anyone that knows what they're doing here, it breaks down to the people, like you said. And I always kid, the Sims are a lot of work, but I could be equally effective as 10 bullet points in an email with a attachment of a pro forma and get exactly the same results. Okay. People that read a book versus meet people don't really know how to do this. Yeah. Let me see the sim, Al, because we do it a little bit different than everyone else. Others will just sign NDAs and send sims all over the place. Once again, you devalue the business. Yeah. We want people that are hot, that are interested, that are qualified. Like I always tell everyone, live by 3 words: qualified. So you're constantly qualifying, even the people you know for 20 years, okay? Control it when you get it, meaning play offense, not defense, because that's what people are expecting you to do, because it's not a good deal if it's not good for both sides, right? Sure. You got to know how to manage that deal. And that's why we've been successful. We manage the people and the process better than anyone. And I firmly believe that. And then execute. A lot of people like charts and graphs and meetings. We fight on, whether it's a Zoom or this or that or face-to-face. The best thing the pandemic ever did was create the Zoom for us, because we'd be running around the country having these meetings, spending more money, expenses and whatnot. It's just as good on Zoom, face-to-face, just like it's just as good right now that we're doing a podcast virtually. But I appreciate you saying that, because like I said, I think there's a lot of the ways that we've done things that, are looked at differently. And I tend to think it's easier and it's smoother and less people involved, less hubbub, less people making comments and whatnot. And we got a bunch of stuff done. You and I are a perfect example. When you look at Inzone, just a comment, I think you did something ingenious there, because as the private equity money came in, it changed the appetite of what people wanted to invest in. You really are investors now. You're not buyers. You're investing in people, okay? You're not just buying it to buy it because it's available. So when the industry, which is very aged in a lot of ways, renewals keep a lot of people in business for a long, long time, okay? But the elder statesmen in this business that have agencies, small agencies, and this last week I spoke to, there's 40,000 insurance agencies. There's about 1,500 over 5 million. Everything else is smaller, right? So you got a ton of them that are under 1 million, a little over 1 million, and they survived for 80, 100 years. Great grandpa to Sonny Jr., right? This continues on. But the thing that you did with Inzone, which was ingenious, okay, is and obviously why you could get people interested in to partner with you, like you did, is you geared up to the stuff that everyone says, the stuff no one else wants. Everybody else wants it, but it's usually kind of a tuck-in. You focused on some of those guys that want to get out of the business. and they were smaller, and you took them in, but you had a plan to integrate them. If they didn't fit into your integration model, they weren't a fit. Okay. And I think that was brilliant, Kevin, because we all know integration is one of the big hot buttons that you guys look for when you look at a new opportunity, right? Integration and organic growth. Everyone knows you're acquiring. Everyone knows you're growing through acquisition. But that was the brilliant thing you did with Inzone. And I know they're kind of branching out in different parts of the country now, because you're getting involved more in our deals. Before, we would just, anything we saw that was small and the guy wanted to leave, we'd call him and we had a deal to do there. We did many of those for them. But I think that was ingenious on your part. That comes from you more than anyone. Not that the folks at Inzone, the CEOs and the management team didn't have a lot to do with it. They did. But that was ingenious. And I do agree with you. King is more like the PCF model. They're not like the Inzone. That's why you're able to be in a couple of these investments at a time, because it's really not as conflicting. Okay, which is what everybody worries about. You're one of the smartest PE guys out there. I don't say that because I'm fond of you and a friend, and we've had success. You are a go-to guy, one of the go-to guys to me, that if I have anything, even if it's outside of insurance brokerage, we've dabbled out of that with the public adjusters now and things of that sort, things that we can make an impact in. We don't like to get involved in anything that we can't dominate, not just participate. Maybe people would disagree. Our competitors certainly would. I think we've pretty much dominated and continue to dominate the insurance distribution space. And I say that out of confidence and a track record that was pretty strong.
Absolutely. Okay. I think the data supports that, but
right,
for sure.
Exactly. Yeah. Right. So that's kind of the thing that I see that you really have done well.
Yeah, I mean, Inzone might be a good way to segue into some of the industry stuff. Happy to do it in whatever cadence you want, but I guess, look, everything's some part luck, some part good. I'd say, yes, we were living the HILB and the PCF experience. We saw sort of increasingly the same amount, if not more, people chasing sort of the top end, as I referenced the bottom end of that pyramid earlier, the top end of that pyramid. So as you say, 1,500 firms, 5 million or greater. And if you extend that sort of collar down a little bit, the number doesn't increase all that much. So really the meat of the curve sits below, as you say, a million, maybe it's 1.25 million to your point. It depends on which data source you're looking at. So yeah, we were living it and seeing it starting to constrain at the top. And certainly as these platforms get bigger, they want to be doing more influential deals than less. And certainly everybody has a machine, but I don't think everyone's built a machine to do some of the smaller deals. And I actually think it's interesting. It's starting to change, but I don't think it really has changed. I think the industry and the way that it's been aggregated in the last, I don't know, maybe 12 years has set itself up structurally to be very difficult actually to be, and I think this is the key word, a consistent acquirer of those small businesses. And what I mean by that is, look, in the beginning, and they've been unbelievably successful, but one of the biggest things Acrisure did to sort of change the game is they were 80% cash, 20% equity, and right. We're going to leave you alone. We're going to right. let you run your business. They were not sort of an integrated. Obviously, they're doing a lot now, and they built a big mass that they're now sort of spending a lot of time and dollars on that. But in the beginning, they weren't, and so. And pretty much everyone followed suit, except for a few players, Inzone being one. And I think what that created is, number one, a small deal is hard to move the needle. Number two, the small deal, if most people want them to stay, if you want them to stay, you've sold them on leaving them alone and not integrating them. And then if they are leaving, most of the buyers wanted to find a place to tuck that into an office or some type of closed physical location. So you sort of have a structural disadvantage on these small ones that to be able to be a consistent acquirer of them, because you're not integrating effectively. You have to bribe one of your local acquisitions with some right. level of cost of capital to take that burden on and give them some financial incentive. And the person may or may not be staying. Sort of Inzone kind of threw all that out the window early days, and they basically said, we're going to be the most integrated model. We're going to be on one AMS, which I know sounds like table stakes today, but it wasn't then. And they're going to be on one instance of that AMS. So you can be in Colorado Springs or you can be in Texas. and it's the same workflows, and they're very defined strategic workflows, and everything is similar no matter where you are and how you do it. Again, this is for micro commercial business. So they have a very unique selling model as well, to your point around kind of organic growth, which is sort of now the hot button phrase of the industry. But we were able to, and as you point out, in the first X number of acquisitions, 50% of the principals did not come with the business.
Right.
Again, that's changing a little bit over time, but we were able to buy these small businesses at reasonable values, integrate them very well, put them on our phones, on our backbone, on our AMS, in our workflows. We were one of the first ones. We actually used to lose deals because we use technology and outsourcing pretty consistently. And some people didn't want that. They want to be left alone. If someone's selling you, hey, I'm going to buy you and give you the same amount of money or maybe more and leave me alone, they were choosing that for a long period of time.
Sure.
And now everyone's sort of saying, well, how can you help me? How can you help me sell more business? That
Right.
wasn't always the case.
No,
You know,
no, you're
so
right. It
the
was a
world's kind of
shift.
come to Inzone, to be honest. We have a business that is fully integrated. We'll do 60, 65 acquisitions this year. We'll be over 100 million of EBITDA. We're growing 6-ish% organically on a true basis, not on a rate adjusted basis, which we can measure and most people can't, at least reasonably well.
At a high margin too. I mean, you're
There
on
we
a
run at a
hard.
true 40, yeah,
Yeah, yeah,
on
you're
that
running
business.
high margin, but you're right, Kev. It did shift because the market shifted. As you get bigger, you have to integrate anyway. Okay, yeah, and why not integrate sooner than later? Because as you get bigger, it gets harder. Back when we exited Hill, it wasn't happening where people were the sponsor would roll at that time. It was kind of a new sponsor. One got in, one got out. That kind of all shifted, and it all shifted from the standpoint also where now by 2020, people were becoming the seller and the buyer fund to fund and staying in these assets. Okay. So I think that shifted too, Kevin, in the market. And I think the integrated model has definitely taken over the unintegrated model. And that's what the entrepreneur gravitated to. Like you said, it was a little even before Acrisure. Acrisure was out there since '05. Greg was doing it in 3 states in the
Yeah.
Midwest for about 8 years before he got to Genstar Capital, and we did the first deal for him here in northern New Jersey, which was a great deal. It shifted, Kevin. It definitely did, and it's now you have to be integrated, you have to be organic. It's got to be working. People want to see that this external growth is working to create organic growth, to cross sell, integration, systems, everything. Okay, so it's definitely there's been some shifts, and I think that's a good segue into the marketplace for us. Let's talk about that a little bit because obviously we've seen for us as far as the deals, the day-to-day deals that we're doing, we haven't seen a real shift in value at all. Now the values are maintaining, and I'm being told every day by certain people that eventually that will come down. And if it does, it does. I mean, we've seen cycles. I've been through it. This is my 37th year, okay, in doing this. But what we have seen is selectivity has gone up, okay, tremendously as far as people that are using their cash wisely because it's way more expensive to get cash with the higher interest rates. That being said, I think the big question I have for you're a very accomplished guy in this space and in private equity. Do you see the private equities leaning at all on insurance distribution? To me, the insurance distribution has been the darling of the private equities. High margin, residual business. You have to have the product by law, almost recession proof. Okay. Do you see in the private equity community the interest level leaning because of maybe some of the things that have happened at the top or the values or the cost of capital? What are your thoughts around that, Kev?
I'd say I can probably only speak for us here and for me. I know while I definitely have some valued relationships of my peers, uh, a lot of private equity folks like to just kind of know what everybody's doing at all times. That's not me. I think we're confident in what we're doing, and we sort of focus to that. So I can speak for us and for myself, but the community itself, I think you're still going to see really strong interest in the space. I mean, if you pull up at kind of a 50,000-foot view for a second, let's stipulate that private equity has literally billions of dollars of capital that's use it or lose it money, right?
Right.
So no one's giving it back. So people are gonna make investments. So that's kind of number one. Number two, sure, obviously water flows into cracks, and there are still sort of places to invest that are a little bit maybe underinvested or less invested. And certainly, I don't have the lens across the entire spectrum of the economy in different sectors, but we look at a variety of different things here. So certainly, there are a myriad of opportunities that maybe have, like I said, less investment compared to others. Um, but not a lot, at least not that we're aware of, that we see that you can build sort of a really good sustainable business at scale. And then sort of, so now you're looking at a myriad of different things. And I always come back and say, wait a second. So I have a business that, pick your number, 87 to 92%. Again, you got to decide whether you're talking about PIF, commission, or premium, but I'm renewing at a very, very strong rate every year.
Right.
Yes, it's a GDP business. So organic growth on a true basis, to your point, you're going to have to do some things to make sure that you're driving that, and it's all coming together, but it's doable. Organic growth to me is just geology. It's time and pressure. Like you have to have a selling culture, and you have to know sort of, this is what we're trying to achieve, and this is how we're going to go about doing it. And in 12 to 18 months, you will see the green shoots of that, maybe even earlier. But it's not going to happen overnight. But you have to be intentional about how you're going to grow your business. But it is doable at the levels that we've been talking about. So if I have a high retaining business that is capable of having GDP organic growth, that has, to your point, a level of economic resistance in it from a downturn perspective, which it does. We've seen that sort of two sort of times. One in kind of the '08 to '10 timeframe, another one during COVID. And I actually think that's to some extent responsible for how valuations have continued to climb. But we've seen the resistance of it in a business that is going to be low end 30% margin. Some people can approach the 40s, and your
Right.
free cash flow conversion is damn near 1 to 1. I mean, you don't really have a lot of leakage from sort of capex and working capital. So, and oh, by the way, yes, there's been somewhere between 5 and 800, acquisitions each year, but you still have, pick your number, 30, 35, 40,000 out there. And yeah, 60% of the premium has probably been acquired. But you're still probably in the fifth inning, maybe, of consolidation. I'm not exactly sure
Right.
what that is. I think you'd be hard pressed to find a lot of other sectors that have those type of characteristics. So no, I think that you're going to continue to get investor interest. I think, as you point out, what we've seen is over time, people have become more discerning. And I think the discerning piece of it has layers. So look, my personal opinion, and thus far I've been right, but doesn't mean I was right for these reasons, and doesn't mean I'll continue to be right. I, like you, did not think that the add-on multiples would fall really at all, and if they did, I thought it would be very modest. Why did I think that? Because as you pointed out before, the number is somewhere between, at any given time, 25 and 50 acquirers out there. And yes, some people may be stilted at different times from a capital structure perspective.
Right.
But you tell me, Al, I mean, you were still getting, even in the depth of COVID, you were still getting 10 or 12 people to show up to your situations
Still do.
when you wanted them, right? And
Still
so
do.
it still
Yep.
do. And it only takes one. And there's a floor value, I think, to these things. Just look again, that given that free cash flow profile, and like what you can do even on an unlevered basis here, like I think it's incredibly compelling. So I think where people have gotten more discerning is given that fundamental premise that the add-ons aren't really going to change materially. Yes, we are buoyed by the public stocks trading really, really well. But I think that's where people first started focusing on integration and saying, okay, well, we need an integrated asset. The funny thing is, I think if you talked about integration 7 years ago, people would have said, well, that means either being on the same AMS or having some type of overlay that you could pull data up. And obviously it's gotten materially more nuanced in the last 7 years as to what true integration means. And I think we're actually on the front end of that for organic growth. Like I was at one of the rare sort of conferences I do go to earlier in the year, and people are like, oh, well, you have to have OG of this and this and this. And the very simple question is, well, let's unpack that. Like, is that PIF? Is that commission? Is that premium? Like, can you even measure it as a business? And the answer is most can't. And so right now, people have most, I shouldn't say all, most people don't have a true understanding at a root level as to what is rate versus PIF versus changes that are happening in their commission structure because of maybe contingencies or carriers or whatever it may be, commissions changing. And so I think organic growth is at the early phase of that unpacking, of really figuring out how to understand the data, get it granular, measure it on a true basis, which is hard because obviously you have exposure and sort of retention stuff that can change in there, but it's doable. And then I think people will start getting more discerning on what actually organic growth looks like. But I think if you, to your original point, if you build, and I guess my original point, if you build a good business that has an M&A machine that can integrate well. And as you said, all the component pieces are coming together, sort of integration, people, sales culture, technology, such that that is driving on a PIF basis, true stick count organic growth. And you can demonstrate that. I actually think to some extent multiples may be slightly even higher than what people have seen historically. And there's a few examples of that in the marketplace in the last kind of 6 to 12 months. There's examples in the marketplace in the last 6 to 12 months of businesses that weren't quite doing that. And yeah, they did not get the valuations I think people have come to expect. So I think that's the evolution that we've gone from to where we are now. Yeah, I mean, 15 years, 12 years ago, you could have, as long as you bought some stuff, like slap the multiple on it and people would buy it. And now people are more discerning and rightfully so. But I think if you know how to win in those sort of component pieces and put together a good business, I'd be surprised if the industry waned in interest. The only other thing I'd say that is out there, at least off the top of my head, to be cognizant of, or at least we're cognizant of, is certainly technology. The rate of change right now is at times scary in technology. I'd say, gosh, the sort of 15 through 20 time period, there was a ton of quote unquote insure tech money going into things. I think the fatal flaw of a lot of those platforms, certainly not all, but they were trying to find ways to displace the broker. What we've really seen in the last 3 or 5 years is most of the things that we've seen out there are trying to help the broker do their job better and more efficiently. And I think that's been a change in sort of the landscape on the front end on the VC side of the business. So I think you're going to keep seeing sort of, and we're already implementing them in both King and Inzone. I think you're going to see technologies that enhance the experience of the broker and make the broker a more profitable, better business. But certainly there is the possibility out there that technology could work to displace the broker. I don't personally subscribe to that. I don't believe that, but at present moment, but perhaps.
It's very well said. Everything you just said, it kind of dovetails on what I always say. It's supply and demand, right? There's enough people out there that have capital. In private equity, you're getting money from people that are trusting you to invest it wisely, and you're going to invest it wisely, but they want you to use it. They're not saying, hey, I'm going to sit around for 6 months and I'm working for the perfect storm, unless you're doing a one-off in one industry or something, which is tough to do. There's people that do focus like that, but you got to use the capital. So you have to be competitive. Some people don't want to be competitive. They don't want to be in a process. But yeah, 10 to 12 people is very easy for us, or 8 to 12 easily to get involved. And we endorse a lot of them and whatnot, including the ones that you're involved in. But I think it comes back to, Kevin, what I'm seeing, and keep saying the same thing, and maybe people don't believe me, but I think it's how you run the process. Even at the higher levels, what's happening now, okay, is there's probably a magic number out there of EBITDA for these growth strategies. Mm-hmm. And when you get to a certain size, I think you're looked at a little differently. And you have a whole other set of investors, okay? And it's a whole different ballgame. So, once again, if you go out and you throw yourself out there to 20 or 30 people, okay, you're throwing yourself to the wolves. That's not going to get you the better deal, in my opinion. The better deal is having the right representation, the right advisors that know the marketplace and study it, not are involved in 15 different industries, that know the market, know that the people that are hot right now and are really unencumbered, and they really want to make the right investment, knowing who those people are at the right time and trying to give them some form of exclusivity to make that deal at the value that you want it, rather than going out and talking to 20, 25 people at once, throwing multiples around and so forth. And then you come up empty, or people bail out, people don't really give you what you want, and then you're frustrated. All right. And that's starting to happen at the bigger broker level, to where none of them were designed to sell to a public, in my opinion. And I think a lot of them position themselves incorrectly that that's going to be their alternative, unfortunately, without specific names or whatnot. And it's not what they ever wanted. The founders, who I know all of them pretty much, and they're at this a long time, never wanted to see that happen. Nothing, not that there's anything wrong with the publics. The publics have done phenomenally well, and they're great in their own right. I don't have anything bad to say about anybody. But the reality is I think it's how you approach your strategy of doing the right thing and going to the right people, just like we did, even at this level, at the smaller level. Okay. And I do think that the bigger investors are trying to kind of reset things a little bit at the higher level. I understand that. But the bottom line here is I think it's how you manage the people and the process. I think that's critical.
I think that's right. And I just to zero in on that for you all specifically, 100% I agree with you on the front end. I think where you're uh, you're not providing maybe enough of a lens or focus on as well. It's the front end, sure, but I'd say you all, Sica Fletcher, and you personally are probably as good, if not the best, I've personally ever worked with and experienced. Of great, you got the deal you wanted with the partner you wanted, but like there's still a whole long road between getting that deal from sort of LOI to closure. And as we know, I always talk to the team and say you rarely to never find anything good in diligence, right? Like all the good stuff they told you up front, it's the speed bumps, it's the problems, it's the thing that happened along the way. And I'd say what you are exceptional, the best I've ever seen of getting the deal done. And we hit issues. We hit issues in you hit issues in every deal. We hit issues in Hill. We hit issues in PCF. I remember Peter wanted to walk on. I don't remember the point, but I remember Peter wanted to walk on something, and it wasn't something that was necessarily controversial. It was misunderstanding might be the wrong word, but it was just something about the business, and we were looking at it differently, and he was interpreting it differently, and you need someone skilled in the depth that understands the business and knows how to, frankly, excuse my French, but get shit done. And I always say, whenever anybody asks me, I say Al's and this, I mean this in a positive way, Al's a force of nature. Like you can't stop him. He will get the deal done for you. And that I think is as valuable a trait as running the front end of the process efficiently and well. Certainly valuable and certainly necessary, but signing an LOI doesn't mean a rip if you don't get the deal done. And I'd be surprised. You could probably count on one hand the number of deals that you didn't figure out how to get over the finish line. And I think that is probably, frankly, your most valuable skill as a partner.
Well, thank you, Kevin. I really appreciate you saying that, because I think there's a lot of criticism around how we manage the client. It's not always, it's a lot of tough love. Okay. They need to understand it's not just get them whatever they want, because why hire us if you're not going to listen to us? I always say, if you listen to us, you'll do great. If you don't, you won't. And it's got to be a great balance. And we take pride in our sim work that we're diligencing their business to prepare them to go into a diligence, because we all know the LOI is non-binding, right? We're looking for your formula. That's what I want. I want your formula, even the moves like you weigh yourself on a diet every day. So show me your formula, right? Show me what it is. And then in diligence, we're going to do a whole new pro forma with the most current time period. It usually doesn't match up the same time period with the sim. The sim can be done months in advance with a different time period. And that's really when your deal is done, when you get through diligence. And then the last 30 days is legal, which is critical too, because you have to have the right legal counsel who knows how to, I call them the kicker. I'm the quarterback, they're the kicker. I'm bringing you in to kick the extra point. That's all you have to do. You don't have to change anything I've already done. And it's very valuable to have the right legal counsel, because that's where things could get screwed up if you have a cowboy or somebody that thinks that they're more important than the deal itself and all the months we spent to get to the last 30 days to finish the deal. But listen, I appreciate what you're saying, because worked very hard in my lifetime, as have my people and my partners, to build this reputation. Okay. And a lot of people don't really know me. You do. I'm not an industry guy that goes out to all the events. I'm not that guy. I stay kind of under the radar a little bit, but the people that know me know that I'm in it to get it done and get it done right for everybody. And I do get criticized to say, when I make the comment that I'm in at some point in the deal, I'm in the deal to get the deal done. You're representing the deal, right?
Yeah.
Because that's what it's all about. If you don't get the deal done, just like I always say to people, what's the most important thing in business? And no one can ever answer the question right. All right. And the most important thing in business to me is getting paid. Because if you don't execute, you don't get paid.
Yeah.
All the other stuff, charts, graphs, everything else, all the other stuff checks the box. The culture's got to be right. The match has to be right. But getting paid means you finish the deal. Okay. And doing everything up to that is very, very important. So listen, I really appreciate it. Your market intel is spot on with mine. A lot of people that are, I think, at the higher levels are doing things because they have to now to get their liquidity. And I do think it's how you go out and manage, but you have to know the market. You have to know where you're going. You have to know a strategy. And unfortunately for us, we're still very much looked at as a boutique. We don't have the pedigree of the big names, the big banks and all those people. So people feel they need that. And a lot of it's because of the finance arrangements that tie back to it. They have the lending capabilities, but I would put us up against anyone in the country, okay, in execution, like you said, and getting the right partner, right deal done quietly for the right value. And I appreciate what you said, and everything between LOI and closing put us up against anyone, anywhere. We do all these deals and we're at the top of the charts, but it's about the people and about doing the right thing for our clients. And that's the only thing that keeps me up at night. I appreciate the client relationship and the partnerships and everything we've done.
No, I appreciate it. Thank you. I mean, look, we don't have, as a firm, we don't send out books to 67 lenders. We have 2. We don't have 5 lawyers we work with. We have 2. We pick people that have good values, want to win, understand how we like to go about things, and we create partnerships. And that's what we have, a bunch of partners in our business, whether it's on the legal side or the advising side or whatever it may be. And I'd be surprised if we have a deeper or longer lasting partnership than we do with you.
I feel there's a lot more to do, and could be some things coming down the pike that you don't know about already that I got my hands on. So anyway, this was awesome. Thank you for joining today.
Yes.
All opinions expressed by the hosts and guests are their own and are not necessarily those of Sica Fletcher. This podcast is for informational purposes only and should not be relied upon as professional advice. Sica Fletcher employees and clients may have positions in the firms discussed in this podcast. Any information provided is subject to change and does not constitute an offer to purchase or sell any financial product. Sica Fletcher LLC does not underwrite securities, nor advise on, nor affect transactions in securities for the account of others. For more information about your unique situation, please contact Sica Fletcher or visit us at www.sicafletcher.com.